All right, we'll get started. First off, I hope everyone's doing well in the middle of this COVID-19 crisis, that everyone's healthy, staying at home. And just a few introductory points. Feel free to ask questions via the Q&A. I'll be checking it, as well as our team will be checking it. If you have questions referring to a particular slide, I'll go back to it and talk specifically about that question. If there are more general questions, our team will answer them for you. And regards to the recording, we will post this in our YouTube page a few days from now. So if you're not able to be there the whole time, or if you want to send it to a friend, the content, feel free to do so. And well, I'll get started now. So let's go through the agenda. First off, I'll start with a brief overview of cryptocurrency exchanges and their history. Then I'll dive into the mechanics of how they work, specifically into how they manage their addresses and their wallets, their types of addresses, and how they interact with each other in order to essentially do treasury management with users and exchanges funds. Referring to mostly centralized exchanges, by the way. Then I'll go into the approach that we took at IntoTheBlock. As you may know, if you follow IntoTheBlock, we take a machine learning first approach into understanding cryptocurrencies, and I'll dive into specifically how we did it to visualize exchange data and how we're able to derive interesting indicators out of these. And related to that, we'll essentially discuss some of the key insights that we were able to derive from this data and how we're productizing them to make you a better trader or cryptocurrency researcher. So let's get started with the introductory part. So one of the first exchanges, MTGOX, funnily enough, it started as a online card exchange. So it stands for Magic the Gathering Online Exchange, but some of you didn't know that. What is more commonly known from MTGOX, however, is their infamous hacks. So they had a series of hacks attacking directly their hot wallet, which is essentially their online wallet where the private keys are online. They do this so that they're more easily send incoming and receiving transactions, but they're also more vulnerable, as you can imagine, being online. So through a series of wallet hacks, they were hacked over 840,000 Bitcoin, which roughly translates to $6 billion today at current prices. Other notable exchange launches include BTCC or BTC China, which at one point was the second largest exchange by trading volume until Chinese regulations got more severe on cryptocurrency trading. Then Bitstamp, which is the longest standing cryptocurrency exchange at this time. Coinbase, which initially started as a wallet in summer 2012 and then added the functionality for exchange, which is what it's more commonly known for nowadays. Kraken and Huobi are other notable exchanges launched in September 2013, and Binance, which is nowadays, by many sources, the largest by trading volume. So I'll focus mostly on centralized exchanges as they're most relevant in terms of trading volume and adoption. Unfortunately, or fortunately, on which point of view, depending on which point of view you see it, decentralized exchanges are still lagging behind in this way in volume. And how have these centralized exchanges progressed? Well, they started, of course, with just Bitcoin trading. Initially was a fiat to crypto gateway. Then they expanded to multiple other tokens and beyond fiat. So, of course, as many of you know, there's direct to BTC or ETH trading pairs. They went from one service, so just purely crypto trading, to multiple. So now several exchanges are offering derivatives, lending, staking. Seems like they have more and more services adding on for consumers to enjoy. And as there's been increasing volumes, unsurprisingly, there's been more hacks as there's more value to be extracted. And this has led to more and better security measures. So I put this image below, which is the Bitcoin blockchain transaction volume in US dollars. So as you can see, the growth in volume has been exponential. peaking at over 30 billion during the 2017 bubble. Essentially, this is verified volume since it's on the Bitcoin blockchain. And when we talk about exchanges, as you can imagine, it's a different picture. So let's talk about the elephant in the room. While blockchains are transparent, centralized exchanges themselves are not. So they operate as a black box in some cases. And there's a lot of estimates and reports saying that, as you might have heard, over 90% of exchange volume is fake, according to these reports. And in order for us to extract information from these institutions, which have been a long-standing part of the cryptocurrency ecosystem, it is important for us to shed light into the data and the actual information that they make, ignoring essentially, well, not ignoring, but looking into what's actually verifiable rather than what they give, what they report, since we cannot at this moment fully trust it. And what better way to do it than using the blockchain data, as this is public and immutable, meaning that it cannot be changed or tampered with. So now let's dive into the mechanics. As I alluded to before, there's hot wallets, which is the main point of interaction, simply because they're online, they're easy way to send and receive transactions. Then there's cold wallets, which are the opposite. They're used for cold storage, which essentially means that they're offline. The private keys are not able to be accessed online, making it more secure and robust. This is usually how exchanges secure funds, and how users should also secure funds in cold wallets themselves. Then there's withdrawal addresses, which, as you can imagine, is the addresses towards which the exchanges send the funds in tokens prior to them leaving the exchange. And deposit addresses have the opposite function. They're the main point of entry into an exchange. So now that we got a bit more familiarized with the main terminology and history of exchanges, I want to dive into the approach that we took here at IntoTheBlock for us to examine and identify cryptocurrency exchanges through using blockchain data. So there's several ways to identify exchanges. One can do so manually, though I wouldn't recommend it. Essentially, I put an asterisk because it wouldn't be fully manually. You would have to use a block explorer to track the addresses and look at which addresses they interact or transfer funds to get a better idea of what function each address has within the ecosystem. Very dull and tedious process. So of course, manually wasn't the best way to tackle this problem. Another way would be clustering. So essentially separating by several categories or factors, and kind of based on many factors, classifying them as one of the three or one of the multiple clusters and their behavior, and matching them to the appropriate type of wallet. And there's classification, which is a bit more binary. It's a discrete way for machine to tackle this with machine learning. So it's essentially defining all of these features as a yes, it is an exchange, and no, this isn't an exchange, and making a very discrete boundary between the two. And then there's regression, which is a more probabilistic approach towards defining whether this set of categories that encompass the activity of a wallet is an exchange and what's the likelihood of it. So at this point, you might be wondering which of these we picked. And it's kind of a trick question because at the end, we decided to go for multiple models. What we thought is, what if we can get the benefits of that many of these models offer, but having limited downside from the issues that can arise from some of these types of models. So what we did is we applied this machine learning technique, which is a bit more modern, called ensemble learning, which is essentially several models within a master model. So you can see it as sub-models within one model. Our CEO, Jesus Rodriguez, he often likes to say something along the lines that assume that all the models are wrong in the long term, and then some can be useful in the short term. So what we're doing this here with our models within the ensemble model is that we're able to retrain some of the individual models and giving them more weight based on the data that we're getting out of them, and making sure that the thesis, the overall thesis, is that the benefits that we can obtain with combining all of these models in one is higher than having just the most accurate out of these four independently. So therefore, combining these and having them continuously trained, gathering more data and identifying more exchange addresses, that way we're work on an efficiently on a diverse data set and able to identify exchange data. So more detailed approach into what we did. We started with the Ethereum blockchain. The reason we did this is because there's a lot more transparent data on the Ethereum blockchain that is validated. So there's multiple sources such as Etherscan, which essentially validate addresses that belong to an exchange or even an ICO or a token. In this case, of course, we focus on the ones that were classified for exchanges, and to use this essentially as a way for us to validate the data. Then after that, we create an ensemble of models using several of the techniques that I mentioned before, and continuously train those on the Ethereum blockchain. After that, we were able to have a general idea of some of the addresses that behaved like exchanges. And based on this, we iterated and essentially applied the model that was optimized for the Ethereum blockchain. And then came the hard part. So once we were able to validate this on the Ethereum blockchain, we had the challenge of being able to apply this to other blockchains, which of course behave in different ways and have blockchain native characteristics. And we were able to, after a remarkable effort from our engineering team, we were able to generalize this to other blockchains. So that way our machine learning essentially learned the main mechanisms of exchanges and applied them to other blockchains based on the behavior that we learned, that they learned, that the algorithms learned, and apply them to other blockchains. And we're currently working on expanding this past Bitcoin. So we tested and predicted on non-Ethereum blockchains. Then we added blockchain-specific heuristics. So UTXO transactions, for example, that they don't exist on Ethereum, we had to apply to the Bitcoin blockchain. And then we optimized the model, iterated, and made sure that the actual data that we extracted was validated. And again, the continuous process of gathering more data and having our learners keep gaining intelligence from cryptocurrency exchanges. And these are the results. They're probably quite overwhelming if this is the first time you see them. At least they were so for me when I first saw them. I'll dive into more specific details. I'm not a machine learning expert, but based on what our engineering team told me, it's essentially the visualization that we're able to create based on all of the components of cryptocurrency exchange. Breaking this down into more granular pieces, we can see how deposit addresses interact. So the deposit addresses, I'm gonna grab the pointer. Deposit addresses are the one in blue. So as you can see, there's clusters of deposit addresses. And essentially what the exchange does is that they gather multiple deposit addresses, and they combine those into a single transaction. They do so into a multi-input transaction in order to essentially save costs. And it will be too costly if they send each transaction individually. So they combine these into a single transaction and send them to a hot wallet, at which point they're online, the funds. And from here, they can go to a cold wallet labeled in black, where funds are more secure. Now, in regards to the withdrawals, it's a similar picture, different colors. So the clusters in this case are in orange. And as you can see, it's kind of similar in the sense that they are also interconnected to a hot wallet. But in this case, as the user seeks to withdraw or have money leave, the tokens leave the exchange, it's the money going from the hot wallet to the transaction, and then that transaction is sent to multiple withdrawal addresses, after which it can leave the exchange and head to another exchange or wallet, whatever the preference of the user is. And we notice sometimes that there's also other withdrawal addresses created short term, and which are model identified. And essentially they act as a point of communication between other withdrawal addresses. We're still not 100% sure why the behavior of the exchanges is like this, but we just did it to identify how they operated. And essentially they're like another point that they added before having funds of the users leave the exchanges. And now a more specific example. More specific example, it would be for Binance. So now that we zoom out and get the bigger picture, we can see how money enters in through the deposit addresses, through these clusters. Then they go pooled into a transaction sent to the hot wallet. So there's usually several hot wallets. We pointed this one for Binance. They have like a central hot wallet, after which they can send the funds to cold wallets, which are the black points here, or they can send it to other hot wallets, which are here. We're less certain about being hot wallets since they're less central, but based on this degree of certainty, we've labeled those that were certain. And so from this green, you can also go into withdraw the clusters of withdrawal addresses, after which the money essentially leaves the exchange, which is flows that are not displayed in this picture. So at this point, you're probably overwhelmed. And so, yeah, you might think this is really complex, maybe kind of cool, but as a regular crypto user, you might be wondering, how does this really apply to me? And how can I make sense out of this data? So this is what I'll discuss in my next section. Essentially, after very thorough work, our engineers have been working on this for almost a year and generalizing this knowledge from the Ethereum blockchain and applying it to Bitcoin. We found some interesting insights. So a bit more context. For the sake of the presentation, I'll focus on year-to-date data with an emphasis on what's called Black Thursday, which was March 12th. They were roughly a third of cryptocurrency value evaporated. Well, not evaporated, but it was sold. And essentially, I wanted to address the price impact and how the exchange factors could be influencing this performance. And we'll look at data from some of the top exchanges: Binance, Huobi, Bitfinex, Kraken, and 7 more. As I mentioned, this is a recurring process of more training these data sets. So we're working to add more exchanges and more tokens into our models. But so far, I'll dive into some of the indicators that we've developed. So this one is regarding essentially the claims or the reports of fake volume. So we thought, what if we could compare the volume that's being reported versus what we know that it's certain and that's actually shown transparently through the blockchain. So if looking at it into the context of the Black Thursday or the large drop, which happened around here, we see that the ratio of volume reported versus the volume that actually was recorded on chain dropped significantly. And this was as volumes increased, indicating that the ratio increased. It increased more the volume for on-chain proportion of this versus the aggregate versus the reported volume. I have a question. 1 second. Let me read it. What do you mean that they group deposits to a single deposit transaction when everyone deposits to different addresses at different times with their own deposit transactions. Is this a secondary transaction afterwards? Okay, so I'll go back to the deposit, so the more granular approach of this. So there's deposit clusters. So as you can see, there's several deposit addresses within this. So the flows coming out of the exchange into the exchange are sent to one of these deposit addresses, and then essentially, as you might have referred to, they're grouped into one individual transaction. So the exchange gathers all of these funds into what's called a multi-input transaction, and then sends these to the hot wallet or one of the hot wallets, essentially in order to, it would be certainly a lot more expensive if they sent each of these deposits directly to the hot wallet. So they gather them and make them into a multi-input transaction that's then sent to the hot wallet prior to being sent to the cold wallets. Hope this answered your question, anonymous attendee. Good question, by the way. I'll go back to this slide. Essentially, I was pointing at the fact how the volumes on-chain increased significantly during the market drop, leading to a decrease in this ratio. However, this is the aggregate out of all the models, exchanges that we have in our model. So the figures actually vary significantly by exchange, depending on how they manage their funds. So here is the ratio for each individual exchange. These are year-to-date figures. An aggregate for the model, and we have an average of 30.19x. So it's the volume reported by them is 30 times greater than the volume recorded on chain. However, as I also referred to with how they group multiple transactions for deposits, it's also very likely that they do this for trading transfers. So they essentially don't have any on-chain movement, which is why there's a large divergence from like 7 times to 92 times from Huobi. We don't see this as a clear indication of there being fake volume. The way we look at it is more for us to have to take it with a grain of salt to see how the exchanges manage their funds. And also we look at each exchange's graph over time. And if there is a sudden spike, we might, our models might identify that as suspicious activity. And then there's another indicator that a lot of people have shown interested in. It's the inflows and outflows indicator. So it essentially monitors all the money entering the exchange versus the money leaving the exchange. We do this through the hot wallets, since as I showed in the previous images, it's kind of the central point through which money enters and leaves the exchange. And we're more certain about, our models are more certain about the money, the tokens entering hot wallets. So in regards to the large market drop, we can see that both inflows and outflows increased significantly during this time. And we found quite particular that the correlation between inflows and outflows summed had a very strong negative correlation with price. Do take this with a grain of salt, however, just because there is a strong correlation at the moment, it doesn't imply causation first, and second, it doesn't mean that it will continue like that. The way we see it is it's another tool to add to your tool set, another indicator to keep watching. I have another question, sorry. Can you speak to the concept that based on-chain analysis, we can see the total amount of coins of any project being stored? With that knowledge, can we know with a relative certainty the size of the largest wallets, and if any one address entity controls more than, say, 1% of all BTC? It's a great question. And we do have an indicator called whales in our IntoTheBlock platform, which essentially measures, we consider whales addresses that have over 1% of circulating supply. And I'll skip one slide and I'll go back to it. But essentially we do have the percentage of circulating supply that's owned by exchanges. So in the model, within our model, which includes Binance, Huobi, Bitfinex, Kraken, and 7 more exchanges, we found that this percentage varied between around over 6 and 5%. So through the blockchain analysis, we can identify these exchanges, and we can identify also flows into the exchanges, which might be able you might be able to digest as a buying or selling signal, especially when there's large increases like this. As you can see, prior or during the market drop, we saw the percentage and the full balance of BTC stored in these exchanges increase, potentially because many of these were panic selling or just selling their tokens. How many addresses did we identify? Is that asking Remco? I'm not 100% sure on the exact number. As you can imagine, there's thousands and thousands of addresses that we identified in our models. Just going back, this is Binance. I don't know if our engineering team is in the call and can provide a more specific number, but it's certainly on the high thousands and with different purposes. But yes, I don't know if anyone from our team is on the chat. If you can answer that, that would be great. I'll continue with the next indicator. Net flows, essentially, is another indicator that we're able to digest from all of this data. And it's essentially the inflows minus the outflows. So this shows the net money entering or leaving the exchange. And what we see is on certain points, inflows outpace outflows significantly, like it was in the case of March 12th. But there's also some points, like in February 13, where there's a much larger amount of outflows. In theory, one may think that when there's more inflows, there's more people with the intent of selling. And it might be the case in some by case, but in the overall trend year to date is a very small negative correlation. So at this moment, we do not identify a clear trend between net flows and price. However, as I mentioned, just because there's currently a small correlation doesn't mean that it'll change in the future. We believe that after all, having more indicators and more insights into your trading or research will essentially make you better or more adept at your whatever you're trying to attempt, similar to how our machine learnings take several models and create one that ensemble modern model together. I'll continue. And this is another indicator that we're coming up with that kind of combines our large transactions indicator. And it's something that one of the anonymous questions might have referred to. So it's essentially the large flows transaction indicator tracks large sums of money or tokens entering or leaving the exchange. So we'll apply the same terminology we use for large transactions, monitoring transactions of over 100,000, which are stored in the blockchain. And that way you can anticipate potential large movements from whales in exchanges. It's work in progress, but it's something we're definitely excited to share as a full product. I'll skip this since I just went to how you're able to track the exchange inventory. Another part I wanted to go into, I'll go quickly, is exchange activity versus liquidity. So we monitor the effects that these flows during the context of the Black Thursday had on exchange liquidity. And as you can see here, unsurprisingly maybe, as there was a large spike in inflows and outflows during the crash, there's also a very large increase in the bid-ask spread for Binance in this case. And this may be due to the overwhelming amount of trading going on and the large prices shifting the market from the makers to the takers who created more urgency. Lastly, comparing this to our trades per side indicator, we can see that the seller volume from the takers was greater, meaning that the sellers were the ones crossing the spread therefore crashing price even further. And this coincided with the spike in inflows, which means a lot of the tokens flowing in net into the exchange were likely from people panic selling, sending money into an exchange for selling purposes, while there was also a spike in buying activity, as you can see later on here, as more money flowed out of the exchange, likely to be stored in cold storage. Anyways, I went slightly over the time, but I hope you enjoyed. Some conclusions that we derived from this data is that, one, of course, it's a very complex process. Do not attempt to do it manually. It's well suited for machine learning. As I mentioned, we have multiple models continuously learning, so we can apply this model not only for Ethereum blockchain, but Bitcoin blockchain, and continuously trading to adapt and learn more addresses and more exchanges and more about the ecosystem, so that we can create a more robust set of intelligence to productize and ship to you, our end users. Exchange activity provides, as I mentioned, as I showed in our key indicators, great information that can be leveraged for trading and researching purposes. As I mentioned, in the context of Black Thursday, there are very strong patterns that emerge. They're all interconnected at the end of the day between liquidity, price action, and exchange flows. So it's definitely something that, as a general user, you might have to take into consideration in order to be better informed about the markets. And yeah, finally, keep an eye out for our exchange analytics release. It's something we've been working on hard, and we're planning on shipping to you before the end of the quarter. So finally, for our next webinar, we'll be talking about another factor that's interconnected, which is how our blockchain indicators connect with technical analysis and how they can be used in order to complement them and improve your trading skills. This is something we constantly ask about: when are we adding technical indicators, et cetera, et cetera. So now we're going to show how you can use both along rather than as a substitute in order to make you a better trader. Our CEO, Jesus Rodriguez, will be taking it on this one. Well, hope you enjoyed. Do you have any final questions? I'll be glad to stick around and answer them for you. I'll wait a few minutes, see if we get more questions. I don't know if regarding how many addresses we identified, it's on the thousands. Unfortunately, our engineering team doesn't have a specific number at this moment, but yeah, it's in the high thousands or so, I'm hearing. Okay, Mikhail, I hope I'm pronouncing that right, is asking, as this space matures, do you ever see centralized exchanges do you ever see centralized exchanges subscribe to some of the transparency initiatives like proof of funds, or it's just simply wishful thinking because all the exchanges find this intel as a competitive advantage? Great question. Very good question. We do see more exchanges actually taking the initiative of identifying themselves some of their addresses, some being the key word. I believe Binance identified some of their addresses for few tokens. I do not see it going full transparent, to be honest. They do have value in their data, unfortunately, and do not, in general, expect too much innovation from incumbents that goes against value that they're creating. More so, I learned in my business classes. So I would expect it more to come maybe as a pressure, as a reaction for if decentralized exchanges continue increasing in market share, then maybe they'll shift towards more transparent approach, but I wouldn't expect them to do it just because. Okay, Rohan is asking, what exchanges do you intend to add in the coming days? So one we're finalizing, well, it's not in the coming days, we're in the quarter, it's Coinbase that we've been working on. So there'll be Binance, Coinbase, Kraken, Bitfinex, HOW, BitTC, around 10 or so. So we're working hard on having as many as possible. Ken is asking, does each user on the exchange actually get their own wallet? Is that why the second transaction to the hot wallet is required for deposits? Why not just deposit to the hot wallet directly and track unique deposit addresses to each user account? Great question. So in short, to the first part, no, every user does not get their own wallet. They do have a deposit address that's shared with more, and then they go into a shared hot wallet, after which they're stored in a shared cold wallet for more secure purposes. So I think one of the reasons they do not deposit directly to the hot wallet is for security purposes. So the deposit addresses are slightly more secure than hot wallets. They're not fully online, private keys that is. Whereas if you have money flowing directly to a hot wallet, it might create incentives for hackers. Well, there's already incentives, but there will be even more if they know that's the main point where money will be entering. Whereas right now, hot wallets are just a quick point in between in the flows of money flowing into the exchange, into the cold wallets. Okay, Mikhail has another question. What is the data telling you about decentralized exchanges traction, especially with the recent uptick in sell-buy activity? Is liquidity pool starting to migrate, or they're still dormant at the big centralized venues? So they've definitely been increasing decentralized exchanges overall. Uniswap, I believe, is currently the first or second. They've been increased a lot, as well as Kyber. However, they're still in the tens of millions at best. I think that was a figure they managed for that during the market drop of March 12th. It was in the tens of millions, whereas it was in the billions. So a significant order of magnitude of difference between centralized exchanges. However, that's still a massive increase from what it was 2 years ago when these were just an idea where people speculated. So I do see them gaining more market share over time. Anonymous attendee asks, thank you and to your organization. The information you are giving to this action is going to revolutionize trading in crypto. Wow, that's not a question. That's a great feedback. I'm glad you enjoyed it. And well, we've gone now almost 10 minutes above the time. Great questions. Hope you guys enjoy the content. Feel free to see it online if you want to go over specific parts again and share with your friends. And we'll cut it at that. Thanks again for your time.